Welcome to Age, Pension, Super and Retirement. I'm your host Yvonne, and as always, this is information only and not personal advice. In today's episode, we will be looking at sequence of returns risk. And to help us unpack this topic, I would like to welcome back the Director of Prosperity Planning Partners, Gayle McKew.
Hello, nice to be here again.
It certainly is. Can we begin, Gayle, by finding out what does the sequence of returns risk concept refer to?
It's actually most commonly impactful on people who are retiring. So if you have, for example, I'm going to mention the global financial crisis because that was 2007, 2008, and it took a long time for the markets to recover from that. So I know of people who were planning on retiring around that time, and they held their retirement off for a couple of years because they literally did not want to start drawing down on their superannuation savings, which were predominantly in growth-based assets. Now, remembering growth-based assets are things like Australian shares, international shares, and property and infrastructure because they tend to go up in value over time. So they didn't want to be drawing down on those particular sectors, particularly when during the GFC, the Australian share market fell by almost 50%. So why would you be wanting to sell two of something to get the same cash value back as you could have previously sold one item? Say CBA as an example, my husband and I were looking at buying CBA shares just prior to the GFC. They were around the $65 mark when we looked at it. We went, let's wait, because the market was a bit, the GFC had started, and we ended up buying them for a little over $27 a share. We got 2.4 shares effectively for what we would have paid for a previous fully priced share pre-GFC. So for somebody like me, where we took advantage of that discount, if you were actually retiring and you were having to sell 2.4 shares to get the same value, same $65, that would be a very negative impact on your overall wealth for the longer term.
Thanks, Gayle. Can I just ask, how could someone avoid selling their growth assets?
There's a couple of ways you can do it. You can have either a cash reserve inside of super or outside of super, and potentially use that cash reserve to fund your lifestyle needs. People definitely keep money outside of super. For those people that I said before who held their retirement off, they actually use some of their work income and some of their savings because they had planned to go on an overseas holiday to pay for that rather than drawing out of the growth assets of their super.
That's really helpful, Gayle. So if there was no other money or what's been termed a bucket strategy, would then someone need to draw down on these growth assets?
100%. So sometimes we see industry super funds, and I'm using them because as a typical example of how unitized investments work. So if you're in a diversified investment, you have a portion of defensive assets and a portion of growth assets depending upon your risk profile, and they are included in your underlying investment. So if you're conservative, you've got more defensive assets than growth assets. If you're balanced, you've got more growth assets than defensive assets. If you're a growth investor, you've got even less defensive assets and more growth assets. So you might have a risk tolerance for it, for volatility, but it doesn't mean you've got a risk tolerance for this sequence of returns. So if the market tumbles and you're having to sell growth assets, that means you're selling more growth assets to get the same fiscal value. So if you're selling $10,000 worth of something valued at $1 a unit, you sell 10,000 units. But if your unit price is 50 cents and you still need $10,000, you have to sell 20,000 units. So that makes a huge impact on investors when they're talking about sequencing of return because they're selling so much more to get the same fiscal value.
Such a helpful answer, Gayle. Thank you. So if we're talking about superannuation, does that mean that people would usually be trying to draw down from something like cash or a conservative bucket?
Or if they've got something that's not going to be impacted by market fluctuations, yes, it would be.
Very good. And how can a lifetime annuity affect the sequence of returns risk?
Well, it tends to smooth it, actually. Most people go, oh, I don't like annuities. Oh, I've got to give up access to my capital. But what it does is, under the current structure, it may help some people get access to a portion of a Centrelink pension. And if by bringing them under the upper asset test limit, and that can then mean that the government co-contributes to your certainty of income by giving you a part pension, you have a part funding of retirement income from the form of an annuity, and then you have your traditional account-based pension.
That's great, Gail. Can I just ask, I'm curious, I hear the phrase transferring the risk to a third party. What is that all about?
That's usually more along the lines of life insurance than investing, because if you think about it, and life insurance, house insurance, car insurance, you pay a certain premium, and most of us don't like always the size of the premium that we quoted. But effectively, let's say you have a $2,000 premium for a life insurance and you're insured for $1 million and you die, and you've got a debt that sits there on your family home. If you die, the $1 million comes to your family tax-free, and it's basically a transference of risk, because I don't have the $1 million to stump up and pay off my mortgage and leave my family in a nice position, but the insurer has taken a bet with me that I'm going to give them money every year and they'll pay my family if something happens to me. That's the transference of risk. Doesn't necessarily apply to all investments. And the other way you can think about it is, if you transfer a degree of risk by creating an income certainty, you can do that with an annuity.
Can you speak a little bit more about that? Perhaps a hypothetical example?
Well, if you go, look, I'm going to give you, I've got some clients, okay, I'll use my lovely 83-year-old female. They put some money into an annuity way back when it was 100% asset test exempt. And that was many moons ago. Centrelink haven't treated the annuities in that way forever. Effectively, they put, I think, $60,000 into it. And last time we checked, she's had about $110,000 paid back to her over time. And the risk was transferred from her that she might run out of life. And the insurance company said, we will pay you until you do run out of life. And effectively, she's one of those people that an annuity has worked very well for, because even though there's no capital value returned to her, she's had more than her capital returned to her over the investment period. Modern annuities don't work that way. They will have a guarantee period, and it's usually up to 10 years. And you will get a portion back depending upon where you fit on that line and your age and so many other variables. But you're transferring the risk of running out of money to the insurer, because they will continue to pay you even if you've run out of money. Does that make sense?
Yeah, that does make sense, Gail. And it's such an interesting story when there was this exemption back in the day. Is there a bit of a guide as to the current annuities? Is there something about a 40% discount for age pension, or is it a little bit more involved than that?
Well, they give you a discount effectively on the asset value that goes in. So recently I put something in place for a client, and if we use $100,000, the capital value goes down to $60,000. That's all that's assessed. And then they give a concession on the income as well. So this is what I said earlier about, it's possible that a lifetime annuity may get you under the asset test upper cap, so that you do start to get that partial co-contribution from the government towards your cash flow.
That's such great information, Gail. Gail, how can you be reached?
On the phone at 0407 159 298, or by email at Gayle, Gayle, at prosperityplanning.com.au.
Thank you. Gail, what is the importance of how much someone spends in regards to the sequence of returns risk?
Traditionally, when people retire, they spend more in the first years. that's if there's sequencing of returns and you've got a negative return happening in the growth assets, then that's going to impact how long it's going to reduce the length of time you've got assets available. But if we go the other way around and think about the sequencing of returns as not all just being risk, there is quite often a trajectory towards positive growth, positive returns, and that can elongate the amount of time somebody has access to capital. Because let's say your drawdown rate on your account-based pension is 5%, and if your fund grew by 8%, then next year, after at the 30th of June each year, they recalculate account-based pension payments, then next year your pension payment would be based on the capital value, including the 3% that didn't get spent, as in a standard drawdown. And potentially some people will have their income increase. Some will have a decrease if the portfolio goes down or they have spent in excess of the usual drawdown rates.
That's really helpful. So perhaps what you're also saying is if there's a degree of flexibility there, especially in those early years, if things are going south when they retire, that's really helpful, but they may be going north.
Well, they could very well be, but as I said to you in the GFC, I had people who went, well, we're just not retiring now. We're going to work for another 2 years and see what has happened in the market. Now, I also had some clients at that time. I was working for a fairly large bank at the time, and they came in and they were talking about their superannuation, but they also had a portfolio of directly owned Australian shares. I said, how do you feel about the market volatility? And they went, we don't care. And I went, oh, okay, tell me more. Because everyone else was listening to the doom and gloom of what was going on the media. And they went, we really don't care, because as long as our income has not changed, it has not impacted our lifestyle. We have no intention of selling these particular shares that are sitting in our portfolio. The fact that they're half of what they used to be means nothing to us, because we focus on income.
That's so interesting, and it really does show the benefits of planning in the sense that if they don't need to sell these growth assets for a long or medium-term period of time, it really does lower the risk.
And to be honest, and I say this to clients all the time, what happens in most instances, people will believe what they see in the media. They will tell you that billions of dollars have been wiped off the share market, but they will never tell you the next day that some of those billions went back on. So the media is all about sharing the bad news. They're not focused in any way, shape, or form on sharing the potential positives of life as an investor.
That's such a good perspective. It's bad news sells, isn't it, Gayle?
Yeah, absolutely. So for me, I just encourage people to be patient, think a little bit outside the box, and maybe just be a little bit less ready to jump out of the market when the media are being doomy and gloomy. Because as Warren Buffett says, it's a great way to transfer wealth from the people who have lived with fear to people who are very happy to accept the opportunity provided by volatility.
That's such an interesting point.
That's my interpretation. It's not his words, but it's basically him saying, yep, there's a lot of money to be made when people are fearful.
So interesting. And we see a fair bit of this panic, don't we, in the Facebook group?
Oh, yes, we do. We do. And every time I see it, I'm like, have you not read the previous posts? But no, they haven't. But my point is more along the lines of people who are advised have a very different outcome than people who are not advised, because people who are advised have got a sounding board that they can pick up the phone and go, hey, what's going on in this particular market? And others will go, oh, Gayle will have spoken to us if there's something we should worry about. And frequently, like even when we had the GFC, when we had Mr. Trump throw his little tariffs around last year, and the markets had a wobble, I wrote to clients and said, we are long-term investors. We are not here to be reacting a knee-jerk response to whatever the media is telling us is going on. And I had one lady ring me and go, so what can we buy? Have we got enough cash to buy something? Everyone else was like, thanks, Gayle. So, it's down to being supported. And if you're not supported, and generally speaking, most people are nowhere near as informed about their investments as they could be, because as you know, in our group, we see people go, I'm not across this. I've ignored it. Whereas we need to be aware that our super, even though we may not be putting contributions to it and our employer is, that money is ours for the future. So you should consider that whether you want to jump in and start to think about it early, or whether you want to wait till retirement and suddenly go, I could have done that smarter. Because I know people who are spending incredible levels of money just on lifestyle, and there's got nothing to show for it, but they've got a great lifestyle. So, out for dinner, out for lunch, all those things. And don't get me wrong, I do some of those things myself, but I don't do them as often as some of my clients do.
Such great information, Gayle. As always, this has been information only and not personal advice. For our international listeners wishing to join our Facebook group, the code word is yellow. Thank you so very much, Gayle.
Thank you.